This is the number of countries around the world with their rising leading economic indicators versus the global manufacturing PMI. So most countries in the world are now seeing their leading economic indicators falling, and that leads global PMI. This is suggesting global PMI comes down below the 50 level into the recession level yet again, confirming that this is not a US thing, it's a global thing. In fact, the US may be the one that survives better, and that's because of the stronger dollar, and we'll come on to that in a bit, but that is a way of moderating prices. Now, markets are also amazing at predicting the business cycle. This is what they do. This is what drives asset prices.
It's no news that the global economy is right on the edge of a potential meltdown. If things continue to progress as the experts envision, we could be heading straight for a recessionary period with many economies grounding to a halt. In a recent podcast, Real Vision CEO and macro guru Raoul Pal discusses his outlook on the global economy and how he expects things to play out from here. He explains that an important economic indicator, the ISM Manufacturing Index, or the Purchasing Managers Index, shows signs of an impending collapse in the United States, the United Kingdom, and several other leading economies. According to recent data released by the ISM Manufacturing Business Survey Committee, there has been yet another drop in manufacturing activities in the United States. The ISM gauge of manufacturing activities dropped to 55.4% in April, down from 57.1% in March. That's a decrease of 1.7 percentage points and the lowest rate since July 2020. We will now take you to Raoul Pal's analysis of how this important indicator and other indicators may be hinting at serious trouble for the global economy. Remember to hit the like button, subscribe to the channel, and drop your comments in the right section below. Thanks and enjoy.
And financial conditions have tightened as well, as you can imagine. And financial conditions take a lot of things like credit spreads that have only just started tightening. Now here you can see the year-on-year rate of change of the Goldman Sachs Financial Conditions Index. That's suggesting the ISM is coming down to 50 as well. Financial conditions are increasing. And I think the Goldman one is not as good as using the model including the inflation on commodities and stuff like that that's not included in the Goldman Sachs index. So again, financial conditions are now tightening and they're getting to levels where we should start to see economic growth suffer significantly. The other thing is, there's an old saying in the commodity world, is the answer to higher prices is higher prices. What does that mean? It means demand destruction. If you raise prices enough, I stop buying. And that is what we see with this next chart. So the PPI, Producer Price Index, so that's the price that manufacturers are buying, raw materials for, that went up a lot. On this chart, it's inverted, and it leads by 18 months. It leads by 18 months inverted, and it suggests that ISM is going to collapse based on this rise in prices. Because what happens is their margins get killed, they can spend less in the economy, there's all impacts on the economy itself. And that tells me that they're probably going to be buying less commodities going forwards due to demand, which is why it moderates the price of commodities, which is one of the reasons why I'm starting to look at the price of oil and starting to think, okay, this could start to be a problem. Now, the issue is with making this video is I'm making this on Monday, the 25th of April. We have to edit it, get it out, and you'll get it the following Monday. Prices, well, it may well have moved a lot. Oil may be down 10%, maybe up 10%. I don't know. But I'm not talking about the short-term moves here. I'm talking about, could oil come back down to $70? I think that's reasonable. Now, that's quite a big fall from here. And it changes the CPI outlook dramatically, because it becomes a net drag in CPI in a year's time, where CPI falls back down to zero. Now, of course, CPI might be different, but just bear with me. This is what I'm talking about, is the complete narrative shift that I think lies ahead. This is also happening globally. This is not a US phenomenon. I use the US just because most of you are watching this from the US, but all of you in Europe, this is happening. Asia, to a certain extent, we're starting to see it too. We're clearly seeing it in China. And here it is. This is the number of countries around the world with their rising leading economic indicators versus the global manufacturing PMI. So most countries in the world are now seeing their leading economic indicators falling, and that leads global PMI. This is suggesting global PMI comes down below the 50 level into the recession level yet again. Again, confirming that this is not a US thing, it's a global thing. In fact, the US may be the one that survives better, and that's because of the stronger dollar, and we'll come on to that in a bit, but that is a way of moderating prices.
Pal also points out the correlation between the S&P 500 and the ISM. He explains that the index has also been closely correlated to the indicator, with a dip in one indicating a similar trend in the other. The S&P 500 is currently trading at $4,155, a 9.30% decrease over the past month. If both continue to tank, there is a chance that the ISM index will drop below 50, indicating there is a contraction in economic growth.
Now, markets are also amazing at predicting the business cycle. This is what they do. This is what drives asset prices. It's what I built my entire investment framework, the understanding of the secular cycle, debt, demographics, deflation, all of these things, globalization, technology, plus the business cycle itself, because the business cycle and the rate of change of the business cycle equals the rate of change of asset prices. And once you understand this, you get to the ability to forecast when we're going to see weak and strong asset prices. So the next chart is the S&P 500 against the ISM. An amazing fit. And this goes back for the entire history of the S&P. It's always been an amazing fit. Equities are cyclical. All assets are pretty much cyclical. And so what it's saying is the S&P currently, and today we're at 4,200, that is suggesting that the ISM is going to get down to 50. If we break lower, and again, I can't tell what this week is going to do, but we're a very kind of precarious setup where we could see another 20%, 10%, 15% downside in the S&P. Now that would start suggesting that the ISM is going to start going below 47, which is recession. So equities are screaming at you that this is happening. And everyone says, well, equities aren't off their high enough. Doesn't matter. It's the rate of change that matters the most. That's the true correlation here. Now, the dollar is cyclical. In fact, the dollar probably drives the cycle. The dollar is the big daddy of the global macro world. It is the denominator for the world's goods and services. The dollar has been going up. The dollar is a global wrecking ball. When the dollar goes up, the business cycle goes down. And when the business cycle goes down, the dollar goes up. It's a feedback loop. It's not just about interest rates. People get it so wrong. Interest rates are a part component in dollar. Interest rate differentials are a part component. Flow of funds, M&A activity, all sorts of things go into what drives the dollar. But the business cycle and the dollar are highly correlated. And the dollar is telling you that the ISM is going to see some sharp falls coming into the summer, and that the narrative is going to shift very quickly from, oh my God, inflation, to, oh my God, growth is slowing. And then it's going to morph, much like 2008 did, is forget about inflation, look at growth. And then, oh, inflation's coming down as well. Oh, we need to stimulate. Those are the paths that we get to.
The macro viewer also points out an interesting correlation between what is playing out now with Russia and what played out during the Saudi oil embargo of the 70s. Pal explains that since both events are so similar, we might have similar economic results. Please listen to his explanation here.
Now, what is interesting to me is I usually say bonds are the truth. But for the first time ever, bonds are just following the ISM as of today. Normally, they tend to give you some sort of outlook. So bonds are not consistent with the S&P and not consistent with the dollar. This is to do with if you remember the chart we showed of CPI versus the ISM inventories and new orders, it kind of disconnected. And the reason it disconnected is the Russia situation and the inflation fears around that and the market struggling to price it. So the bond market is currently not pricing economic weakness. And I'm suggesting that CPI is going to fall as well. So I'm kind of focused on bonds. You've started hearing me talk about it. I had one shot in Macro Insiders. I bought some calls in TLT. I was too early. I'm often early. But I think we're getting very, very close to the bond market taking everybody out and shooting it by yields falling fast. Because everybody is one way, because they're all betting on ongoing inflation and the chart of truth. And we'll come on to the chart of truth in a bit. You see, the narrative in people's heads is the 1970s. That's when we had inflation. We're going back to the 70s. So I went back and looked at the 70s, the period that looked most similar. The period that looks most similar is 1974, the Arab oil embargo. The Arabs basically took oil out of the economy and said, you can't have it. Now, what that did was drive up the price of oil. Same with the Russian situation now. And what happened was CPI exploded. It went up from about 3% and went up to 12%. Very similar to the kinds of numbers we see now. Now, what happened was exactly what I'm expecting. As CPI peaked, the economy cratered, and the ISM, as you can see on this chart, fell to its lowest level in history of 30. Because the global economy ground to a halt, it couldn't deal with the supply shock and demand collapsed. Bond yields went down super fast again. They rose later in the 70s because, again, we had the Iran situation with oil, but we also then had the baby boomers coming into the workforce. That is not a repeat setup. We do not have the same again. We don't have a step change in demand. We have the ongoing demand of the global economy.
This is as macro as it gets. The Real Vision CEO and co-founder really delves into some important stuff. From his analysis and the Federal Reserve's announcement that it would continue to raise interests until the economy slows down drastically, there are definitely some uncertain times ahead. What do you think about Pal's analysis? Does the world economy ground to a halt? Or do you see the markets recovering soon? And do you think everything impacts the cryptocurrency space? Please drop your comments and observations in the comment section below, and don't forget to hit the like button. Thanks for watching.